Hey guys, back with another video. So as part of the budget, they announced a 30% tax on distributions from trusts. So I probably wanted to go through this in a bit more detail and explain what that is and how that works for trusts, probably to show the importance of how much of a game changer this actually is. Okay, so we've got two examples here. Example one, so we've got a business. So with trusts, normally most of our clients, it's a mum and dad business owner that have a trust. So we've got in year one, they started out just a mum and dad business. They made 100 grand profit in year one. So out of that 100 grand profit, from a tax point of view, the old way of doing things, they could distribute just under $1,000 to their two kids, and the rest goes to mum and dad. So just under 50 grand each from a tax point of view. So the old way, they paid $13,000 worth of tax for the year. Under the new way, 30% tax straight on that $100,000, which means $30,000 in tax, which means the business owner, mum and dad business, making $100,000 a year, now has an extra $17,000 in tax. So these figures are very rough numbers, but that is pretty much what happens anyway. So overnight, $100,000 mum and dad business now has an extra $17,000 in tax to pay. So there are ways around these things. Obviously we will talk about structuring, but this is what will happen if we do nothing at all prior to 30 June for these sort of examples. They will be up for this extra 17 grand worth of tax. All right, so in year two, this same mum and dad business, they want to grow the business. So they take on a lot of risk. They go and market and advertise their business. They take on a lot of staff. They go and get a commercial lease in place, and they put their house on the line to really build the business and take on a lot of risk to have a go. So in year two, they're successful in their business. They make $600,000 in profit in year two. So what happens to that profit? So under the old rules, a trust doesn't pay tax. We can distribute to who we want and they pay tax on it. So under the old way, they had mum and dad had $190,000 each. The two kids, so just under $1,000 tax-free. And they put the remaining $220,000 into an investment company. So with that $220,000, the cash was transferred to an investment company, and they've used that money to go and invest in assets. So whether that's shares, property, equipment for the business, to really grow their wealth that way. Okay, so the new way. Two kids no longer get any tax-free money. Investment company, gone. Double taxation. From what we know at the moment, that company will get double tax. So the trust pays 30%, then that company will pay an extra 25 or 30%. We're not 100% sure yet, but we know at this stage it will get double taxed. So it's gone, out the window. Under the old way, they would have paid $165,000 in tax across the board. Under this new way, it will be $214,000 in tax. So there's an extra $49,000 in extra tax for this business that has taken on a lot of risk by employing people, advertising, and really having a go anyway. So an extra $49,000 in tax for these guys if there is no restructuring in place. So obviously a lot of our clients are mum and dad business owners. That's what who we like to deal with. Mum and dad business owners typically can run through businesses through trusts. As you can see, there's extra tax whether you're on the lower end of the profits or the higher end of profits. There's extra tax. It's only probably somewhere in the middle there that you probably may not pay extra tax, but everyone knows in business, there's never smooth sailing. There's good years and bad years, and things change. So at some point, you may get caught out. So this is a conversation we need to have. So we have 2 years before these new rules kick in. So we've got 2 years to look at your situation and get your restructuring correct prior to the 1st of July 2028 to make sure that you're not overpaying in tax. So this is something we will be reviewing your situation over the next few months or the next 12 months to make sure that you are in the correct entity and structured position moving forward prior to the new rules coming in, so you don't pay an extra $49,000 in tax.